Hello all, welcome to my channel. My name is Prajakta Bapat and today's topic is buyback of shares. In the previous video, we have discussed about what is buyback and what are the reasons behind buyback. Today we will be discussing about conditions to be followed by the companies going for the buyback. So the first condition is special resolution in the general meeting. Now, whenever company decides to go for the buyback, first they have to pass special resolution in the general meeting. Along with that, when the notice for general meeting is sent, in the notice, in the agenda, this buyback point has to be mentioned along with the need for buyback. Why company is going for the buyback, purpose of that has to be mentioned in the agenda. Second point is company can buy back fully paid shares only. We all know that shares are first, the value for shares is first called up to face value and then it is paid up by the shareholders. So if the shares are, if the particular securities are fully paid, then only company can buy back the same securities. Otherwise, company cannot go for buyback of the said securities. But in case of academics, in particular question, we may not have shares which are fully paid. In that case, we are supposed to make a final call. We are supposed to assume that company has made a final call, make those shares fully paid, and then go for the buyback of same securities. Third point is company cannot cancel the offer of buyback once it is declared. So once the company puts this offer, once the company announces this offer to the public, company cannot cancel that or take back that offer in any case. Next point, company can buy back maximum 25% of its shares. The number of shares which are outstanding in the market, outstanding meaning number of shares which are already issued in the market or in the public, out of that only 25% of the shares can be bought back at a time, and within two buyback there has to be a time gap of minimum 1 year. Okay, so maximum 25% meaning if you have number of shares, this condition talks about number of shares. So if you have 100 shares in the market, you can maximum buy back only 25% of the shares, that is 25 shares out of 100 shares at a time. Next condition speaks about the amount to be paid. Now when I buy back securities, meaning I purchase back securities from the market. So I have to pay back the amount obviously. Now that amount, how much amount I can pay? So this condition speaks about maximum amount paid on buyback should be 25%. Now 25% of what? Of paid up capital plus free reserves plus security premium. Paid up capital includes equity plus preference paid up by the shareholders. Up to what percentage or up to what limit it is paid up. So that paid up value you will take, plus free reserves. Free reserves meaning divisible profits. In the next video we are going to discuss about this free reserves in detail. Plus security premium. Security premium is the premium which is taken at the time of issue of securities. So adding these all things, 25% of that amount maximum can be paid by the company for buyback. Now last but very important point, post buyback, that means after buyback, debt equity ratio should not be more than 2:1. Now debt equity ratio shows your proportion of borrowed fund and proportion of your own fund. The standard ratio, as we have discussed in the previous video, it has to be 2:1. Now in particular case, because of this problem, such issues, they may not have standard ratio of 2:1. But in case of buyback, when I go for buyback, part of equity is reduced because I cancel the capital. So what the rule says, after buyback also your debt equity ratio should not increase. It should not go beyond a 2:1 because obviously I am reducing a part of equity. So obviously it will have impact on debt also, and there can be change in this proportion, in this combination. So in any case, it should not go more than 2:1. So these are the conditions which are to be followed by the companies before going for buyback of securities.